Hi students, so welcome back to our next class. This is class number 19. Okay, so here we are starting with the second chapter of CMA and financial management, which is budgeting and budgetary control. So friends and students, so this is the second unit. So for the last 18 classes, we were doing with the chapter number 1, which is having a very high weightage, which should be more than 10 plus to maybe 15 plus marks also may be covered. So please be thorough with marginal costing. That is the basic fundamental for the costing subject, and also that will help you a lot for your interview preparations. If you want to by completing group 1, if you want to appear for any interview for the costing department or any manufacturing companies, last 18 classes, please watch that. I have put my best to discuss the problems as well as share my industrial knowledge on each problem. Okay, so now we are moving to the chapter number 2, which is budgeting and budgetary control, which is lot more interesting and more professional subject. And this knowledge is very much sufficient after you complete your inter. The interview questions may be mostly on the budgeting and budgetary control. If you are going for the manufacturing, sure, there will be budgeting related work. You may be working in the inventory department or costing department or forecasting team. There will be a lot of team, maybe the sales accounting team. So wherever you go, budget is something which you have to follow with some technical team, and you have to report it to the central corporate finance, and they will consolidate, have lot of to and fro discussions, and finalize the final budget. So this is going to be a word which will you will use it on daily basis, and you need to have a complete knowledge about it. Okay, the complete knowledge about the whole organization is required for understanding the concepts of budget. So let me take you through that. So we are in the chapter 2. All the best for you. Let's try to complete this whole subject, and for this June examination, let us prepare well. Okay, so introduction to budgeting and budgeting control. So what is this budget? So budgets are basically targets. So these are targets approved by the top management. So what will top management approve? Top management will approve something that has come to their table. So the budget is finalized by the finance department after review of various levels of finance department, and maybe vice president or president level of finance department will take it to the director level or MD level approval. And in some companies, maybe the president may be the deciding authority or approving authority based on the respective authority level as decided by the policy or the guidelines what company follows. These targets will be placed for their approval, and some questions or will be asked, which will be answered by the technical team, maybe the manufacturing head or the factory head, as well as the finance head, and final approvals you will get. So these are the targets which you have to accomplish for your next year. This may be a financial goals or numerical goals. These are all numbers. Okay, maybe a company will have some targets like we have to invent a new product. So all those things are related to some targets for the research and development team. But financially, what is the target? And that is the budget. Okay, actuals. Okay, and finance department will be the single point contact for preparing the doing the month close for every month closing activity, booking the accruals, and doing all the journal postings at the month end. And quarterly end, they will also make the P&L statement and balance sheet. If they are a listed company, they have to follow this for every quarter, doing the variance analysis, so to report to the stock market and the investors. So the actuals is nothing but the P&L and L and the balance sheet, which is the closing P&L and balance sheet. This will be taken, and you will already have a budget. You have to compare the what are the targets, what are the actual month on month, quarter versus quarter, year last year versus current year. So all this type of comparison, meaningful comparison we make, and we create a variance report, that is nothing but a variance. So variance analysis is nothing but what has gone wrong, what has gone right, what are some controllable variations that has taken place, what are some uncontrollable variance that has taken place. For example, government is issuing policy to increase the diesel price. That is not controllable by us, but it is going to show adverse variance in your variance analysis. And similarly, there may be some uncontrollable favorable variance also. Okay, and when you come to the controllable variance, there may be a production unit which has to produce 10 numbers. In that place, they have produced only 9 numbers. So this will be like the labor cost per unit would have gone up. Okay, so while doing the analysis, that may be a negative variance, and uh, we may undergone some quality issues, and we would have recalled some product from the customer, do some free repairs, and then give back to the customer. So all this are unforecasted things or not budgeted things that has happened. Okay, but maybe possible to control or maybe not controllable. Okay, so these are all the complete target, actual and variance, and giving a elaborate meaningful statement to the management, and that is a variance analysis. Next, on the policy point of view, budget should have a policy. So as per the policy, the different departments has to give inputs to you. They have to follow the policy, and also while doing the actual expenditure, there will be a lot of approval authority. For example, if they are making a purchase requisition for 10,000 rupees, maybe the manager of the department can approve it. And if they are making for greater than 1 lakh, then HOD may be approving. If they are making for greater than 10 lakhs, vice president level approval may be required. So these are all the policy guidelines. These are all, what are the benefits for this? The main benefit is the cost cutting. Okay, maybe the upper level person may reject it, saying that don't go for this vendor, go for a different vendor, or don't go through this method, you go through the alternate mechanism or a cheaper mechanism. Or the higher level people, when it goes for the approval, they may say that our group company is already doing this, we did not duplicate this, we can implement this right away. I will give you the right contact for that. So this kind of cost cutting may happen at the group level or a consolidated basis. The next thing is the performance management. So when the targets are approved, we have to achieve the target for the year end. The year target will be breakdown into quarterly target, half-yearly target, and for respective department, the performance management system will be there under the control of HR, and they have to achieve their budget for the activity. So if you are responsible for the engine shop, then engine shop will have a budget for the year approved by the top management, and you have to meet that budget at any cost. Okay, now you have to meet that budget at any cost. This has a disadvantage also. Though it is looks like very good, there are some disadvantages. So what is the disadvantage? May not contribute to long-term objective. For example, your competitor is doing something new and you have to do something new at that point of time. Because of the budget constraints, you are postponing the activity to the next financial year. Is it good? It may be a very critical activity, but to achieve your target, and only if you achieve the target, you will get better rating in your performance management. We may postpone the things. This is a very drastic or disadvantage of the budget. Okay, so the team has to ensure a separate approval is taken. Okay, this is not a, this is the budget and this is my target. This is some activity which is not planned in my budget, so I have to take this separately for the management approval and get appropriate budget for it, specially sanctioned for it, like a special sanction or premium sanction. This has to be separately sanctioned over and above the budget. So many people who are not empowered may tend to do this mistake, postpone the things to the next financial so that we can achieve the target and get good ratings. So this is a usual disadvantage that is happening, but it's actually not a disadvantage. Though if it is critical, you have to take it to the top management and get a separate sanctions. Allows lazy targets. So sometimes some department may give a lazy target. So their forecast will be like 1 lakh, they would have given 1.2 lakhs. So as a finance department, we have to negotiate as much as possible, take all possible previous year P&Ls, what is actually they have expended, and why they are asking so much money, or why the, and the market may be favorable, or cost of the plastic, commodity, some of the commodity may be reducing, still the purchase department may ask for the more budget. Okay, so you have to know about the market also, the dynamics of the market, the each and every commodities, how the price movements are happening, what is the latest price and what is the 6 months average, what are the last 3 months average. With that, the purchase department, you have to have a very strong negotiation with the purchase department to finalize the budget. They may give 10 rupees for a item, and it will be easy for them to make it 9 rupees itself, and they will make 9 rupee, and they will get they will achieve the target also, and they will get good rating also. We have to not allow it. We have to fix 9 as a target, and moving from 9 to 8 may be a difficult thing for the purchase department. So the target should be like a difficult thing to achieve. It should not be a very lazy one. Yeah, budget requires an organization structure. Only when organization structure is there, various department will be there, and department will have a target for it, and there will be policies, output level. So as a company, what is your production output level? And there should be a good accounting system. Then only the exact department cost or product cost will be allocated to that. So usually the companies use SAP as a standard system. There are some other ERPs also. I also request all my followers to have a good knowledge about SAP. Okay, there are good service providers, and if you want to know, you can separately ping me. I will give you the details about the service providers for taking the SAP course. Okay, so that is the accounting system. Next is the functional budget. So what are the function? Various department will have the budget for itself, and that is called the functional budget or departmental budget. So first department, what we are going to see is the sales budget. So what is sales budget? It is a mighty document which is given by the sales department or marketing department. So what do they have? They have the sales quantity, forecasted sales quantity. Next year, this will be my sales quantity, my sales revenue. Okay, sales quantity multiplied by the selling price will give you the revenue. So this is my forecasted sales revenue for the next financial year. This is like a number, numerical data, but we as a finance people, as a cost and management account, we will not be satisfied just by these numbers. Okay, just coming and giving some numbers, finance people cannot be satisfied, and a CMA cannot be satisfied. So we have to ask for much more drill down details as much as possible, so that we are fully satisfied, and only when we are fully satisfied, we can explain this to the top management, that this is what is the benefit for which the management, the departments are asking. I am on their side. I am fully convinced, and we can convince the top management. If we ourselves are not convinced, then the approval is going to take a lot of time. So you will go, and the top people will say something different. You will bring back, run behind the departmental people. This to and fro movements will happen, and you will take a lot of months to finalize the budget itself. Okay, so market. So what are all the professional details we have to ask? Market wise sales forecast. Though if you take India, there are different states or different markets. The people's choices will be different, their taste, colors, taste on the colors, taste on the, if it is an automobile, their color, their engine, power. So all those requirements for a one who is sitting in the Maharashtra will be different from those of Tamil Nadu. So Tamil Nadu maximum it is a flat region, and Maharashtra it's totally ups and downs, a lot of hills will be there. So their engine preference, their preference for the different things will be different. Equipment level preference will be different. So this is what is the market wise. So market wise, the selling department or marketing department would have analyzed, and they would have given market wise forecast. So this is the first next level detail as a professionals we have to ask for. What is the next thing is the product portfolio. So what are all the product you have, and what is your portfolio? So as a company, you have 10 products. So that is your portfolio, product portfolio. Then product wise market share. So market share is for last 3 years, last 5 years market share, you can ask for it. So certain products will have increase in the market share, certain items may have flat, and certain items may have the fall in market share. What innovations or product differentiation you are going to bring in, and what is the investment required for that? Okay, and how you are going to achieve more market share. So sometimes marketing department may say, I will sell 10 items of this, but the market share will be keep on falling from for the last 5 years, like 10, 7, 6, 5, and now they will suddenly say I will sell 10. How that will happen? I have not approved separate budget for any doing the product differentiation or any innovation on the product. So how you will attain 10? So we have to question them based on the P&L, based on what has actually happened, based on the last year budget what we have given, based on the market scenario, product portfolio, what is the market share and how it is moving. Okay, or maybe they would have spent some advertisement expenditure. What specially you have spent, and why, how you say that sales will suddenly go up? So we have to question on those things. So if they have said market share will go up for item, and proportionately they have asked for higher advertisement expense also, that makes sense. Okay, next is the production department, which has a production plan. So sales is ready, you have to sell 1 lakh of item, so something has to be produced, right? So that is the production budget. So it will have a production plan, and capacity has to be checked. Sometimes the production plan will be 1 lakh, your capacity is only 80,000, which means in-house you can produce 80,000. Whether we can buy from outside the remaining 20,000 by spending some conversion cost, sending the raw material to the outside job work basis, we can do our finished goods. So something like that, we have to do the capacity planning. And next is the inventory policy. Okay, we cannot hit so much of inventory and keep on the inventory. So inventory has to be in control. For that, inventory policy has to be there. And sales budget is also required. That is a very key input for making your production budget. So other budgets, what are all is there? A material budget. So material wise, there will be a lot of raw material list you will be using. So what is the quantity, opening stock, closing stock, how much purchases are required? So that is the material budget. And separately purchase budget. So what is the cost of purchase for different items? So for example, material A may have supplier 1, supplier 2, supplier 3. These three supplier will have different cost. So what will be the logistics cost for bringing from the each supplier? What will be the raw material cost? So that is the total purchase budget. Cash budget, how the cash scenario will be. Sometimes you may miss the cash budget, so the cash may go down suddenly because customers payment will take time to reach. So you may be in a situation where you cannot pay to your creditors, or you cannot even pay to the employees salaries, okay, because customers payment has delayed. So this cash budget, or doing the budget versus actual, will give a signal to the respective sales team that get the money from customer as soon as possible, or next month we will have a cash crunch, we cannot even pay to our bills, or we cannot even pay salary to our employees. So we have to forecast this early. So cash budget is required. So personnel budget, HR department will maintain that. Capital expenditure, so capital expenditure is capex budget, admin budget, and research and development budget. So keep on research and development has to take place. And nowadays the products are if you are using a product for 1 or 2 months, a competitor will come and release a new product, and our taste will change to that. And what happened to the company that has given you the earlier product? They have to keep on do research and development. What specialities our competitors has given, they have to do that innovation. So R&D budget will be a very almost 30 to 40% of the whole budget sometimes for a company. Okay, so fixed budget is something like I will produce 1 lakh unit, and this is a budget for that. So that is level of one level of activity. But flexible budget is something multiple level of activity. If market is favorable, I may produce 1 lakh 20,000. If market is flat, I may produce 1 lakh. If market is bad, I may even produce 80,000. So for different level of activities, we are doing the budget for it. It is a complicated activity, but we have to do this kind of budget, because actual, if sometimes actual, for example, you have done a flexible budget for 1 lakh 20,000 production, 1 lakh production, 80,000 production, and your actual is 78,000. You can compare your actual with 80,000 budget. So this is the level of flexibility we will have in that. So we can do a more meaningful variance analysis. So there is one last concept, guys, which is zero based budgeting. So what is that zero based budgeting? Okay, usually for research and development team, what they do, each every year they will do a different set of activity. Okay, last year your department budget may be 1 lakh rupee, and the same guy will come and give you the 1 lakh rupee for the this year also. So what you will do in this year, he will say the same set of activities. Those projects are already over, so you cannot say that this year what project you have. So you have to work from scratch for that. So this is called without any base, without any past P&L data, without any past experience. Work as if you are a startup, like a fresh budgeting. Do all the thing. If there is a supplier already existing, try to look for a new supplier if they can do for a lesser cost also. With a zero base, we are doing the budgeting, and that's called zero based budgeting. So in this process, we will be doing a lot of detailed analysis of the activity, whether any alternatives is possible. Maximum possible cost cutting will happen at the departmental level itself. As a finance department, we have to go through all those steps what the team has, departments has done before it is coming to our desk, so that we will understand that these types of cost cuttings has already happened in the departmental level, and we will not question the same thing once again. Okay, so the ranking of activities, we will be doing the ranking of activities. So based on the ranking, we will select the activities and funding, and we can take for the further approval. So guys, till now we have discussed in detail almost about the budget. This is what is the practical experience I have in the budgeting. This is what is given in your book, but maybe it is little elaborate, but I have given you as brief as possible. Okay, which may help you for the objective type question. Let us move to solve one or two problems too. Yes, guys. So this is the first problem. So here there are some details given here for the January 2015. So there are various materials, the A, B, C, D, E, F. These are the various raw materials the company is using. And the stock on Jan 1st is given, stock on Jan 31st is given. So period is January. So opening stock is given, closing stock is given. Estimated consumption is given. Okay, so what is consumed? What is actually consumed? So these are the from the stores you have given to the production, and in the production you have consumed it. So that is the actual consumption that has taken place, and standard price is also given, which means the per unit cost is also given. Okay, so we all know one formula. What is consumption? So what raw material, what is consumed for a period is opening stock during that period plus purchases what has happened, and we are left out with some closing stock, so minus the closing stock. So that is going to be the consumption that has taken place during the period. Here what we have to do is making the raw material purchase budget. So we have to find what is the purchases. So if you want to do what is purchases, just realign this formula. So purchases will be consumption plus closing stock minus opening stock. So consumption plus opening stock, closing stock minus opening stock will give you the total purchases that has taken place during the period, and we are going to make the purchase budget. So total purchasing quantity multiplied by the per unit cost is going to give the purchasing budget, which is in rupees. That is the target of raw material purchases. Okay, so RM consumption, it is given in the question. Just I have taken the same row. Okay, we have been given the closing stock also. So consumption plus closing stock, I'm adding to it, and I'm reducing the opening stock. So I will land up at RM purchases. Okay, so there is a slight mistake, students. What I have seen, some students, they have put the purchases equal to opening stock plus consumption minus closing stock, which is not right. They have to do the vice versa of the location of consumption and purchases. Consumption is equal to opening stock plus what you have purchased, and that is the total, and you are left out with the closing stock. So minus closing stock, that is going to give you the actual consumption. So just apply this formula. You can find the RM purchases and multiplied by the piece price that is also given, which is the standard price. You can find the purchase budget. So for material A, the budget is 31,000 rupees. Actually, it may be upper or lower, adverse variance or favorable variance. But this is the budget as per the budget documents. Okay. This is a very simple problem, maybe a 2-mark problem. Next, we will little bit of complexity. We will go to one more problem, which is little bit complex. A company manufactures two products, product A and product B. Okay, year ending 31st December 2015, it is expected to sell. So from the sales department, the budget has already come. It is expected to sell 15,000 kg of product A and 75,000 kg of product B. Okay, and per kg what is the rate is also given. Okay, so finished goods, we can value it because finished goods rate is given. Okay, respectively the direct materials PQR. So product A, product B are the end items or the finished goods, and PQR are the raw materials mixed in the proportion 3:5:2 to manufacture product A. So 3:5:2 of PQR will give you the product A, And if you take the Q and R and mix it in the proportion 1:2, it will give you the product B. So how to make the product A, how to make the product B, that is also given to us. The actual and budget inventories are for the year are given below. So what are all the inventory items? So inventory items is P, Q, R are the materials, A and B are the products. So this is our inventory. That is the raw material inventory. That is a finished goods inventory. So for all this inventory, opening stock is given, line by line opening stock is given, closing stock is given, and also the piece price or the cost per kg is also given. So what we have to do, make a production budget and make a material budget. Material budget already we made in our last problem, which is going to be very similar to that. But production budget is something new. So what is the production budget? So last time we saw a formula which is given here. RM purchases is equal to consumption plus closing stock minus opening stock. This can be said in a different way, which is RM consumption, what is consumed during the period, is equal to what you have in the opening stock plus what are all the purchases that has come in minus what is the closing stock left out in the period. That will be the total consumption that has happened. So that is the formula which we saw in the previous problem, that will be applied here also. And there is one more from the end item point of view. This is the raw material point of view, but from the end item point of view or the finished goods point of view, the total sales that has taken place is equal to opening stock of the goods or the finished goods plus the production what you have done on the finished goods minus closing stock of the finished goods that is left out. So that is going to give you the sales that has happened in that period. Okay, so I am just applying this formula. Sales we have already got 15,000 kg and 75,000 kg for the product A and product B, which is already given in the question. So sales plus the closing stock, okay, we are just adding it, and minus the opening stock will give you the production quantity. This is just a realignment of this formula. So we are moving the production here and sales here. The production will be equal to sales plus closing stock minus opening stock. So I am applying this and finding the production quantity. And I can also say in the numerical value, if the product A, product B, the cost of the product is given, I can multiply by the cost of the product, and I can also say this is the production budget in rupees. I can say that, but the cost is not given for it. So we can say give the production budget only at the quantity level, not at the cost level. That is the first thing. Next, we have to find the material budget. So we have, this is little challenging because it is given what, okay, so we are going to produce 13,500 of product A and 75,500 of product B. So for this production from the stores we have to issue material. So what is the material? PQR are the raw materials, and PQR should be mixed in 3:5:2 to make the product A. So product A we are going to make 13,500, and if 13,500 kg is split in the ratio 3:5:2, it becomes 4,050 is to 6,750 is to 2,700. I hope my students will not have any issues with this ratio allocation. So if you total all this three, it will come to 13,500. So 13,500 is split in this ratio. And for making the product B, you have to mix Q and R in 1:2 ratio. So product B 75,500 is required. So 75,500 Q and R is required in this amount. So you are splitting in 1:2 proportion. This is the proportion. So what is the total material that is required for making this as per to achieve this production plan? This is the, so I am just adding material issued to A and material issued to B. This is the total material PQR that is issued to the to make the production. Okay, now this is what is the, what is issued to the production or what is consumed from the stores, plus what is the closing stock. Yes, that is given in the question. PQR closing stock is given in the question. We are just applying this formula. Okay, plus closing stock, we are just adding it and reducing the opening stock, and we can find the purchase quantity. So raw material purchase quantity we have, and we have surprisingly the cost per unit of the raw materials also. So we can multiply and we can say the purchase budget in the quantity level also, and also multiply by the unit cost. We can also say at the rupees level also. So this is a little bit challenging problem. So I will cut my classes with this for today. So meet you soon, students. All the very best for your examination. Thank you.